to be presenting on his findings and how COVID has affected both his field and his research. For those who do not know, Professor Parsley is a professor in economics and finance, and he teaches one of the core classes during Mod 4, I believe, called, correct me if I'm wrong here, Professor, because I wasn't actually in your class, but Business in the Global Economy. So y'all should look forward to that if you haven't taken it already. And Professor, I will hand it over to you to take away.
Okay, great. That works pretty well. And thank you guys. I wanted to thank Mackenzie and you for inviting me and setting up this series. I think it's pretty interesting. It's a nice substitute since I don't get to see any of my colleagues. I don't get to see any students. So and I'm not really seeing people now, just their pictures mostly, or their names, but they're here in spirit, I can tell. So yes, in the original email, I was asked to talk about how this pandemic and shutdown is affecting me and my profession. So that was pretty cool. So I started looking into that, and I'm excited to share this with you today. Whoops. So what I plan to do is just three things. First, I can't get away from talking about the economics of the pandemic. Then a little bit about how it's changed teaching, and a little bit about how it's changed research. I'm not going to really be talking about any of my research, but what's going on in the profession. So Ken Rogoff is a famous economist. He's also in my class, sometimes I mention him. They wrote the book, This Time is Different, Ken Rogoff and Carmen Reinhardt. During the last financial crisis, they unleashed this massive tome, about 800 pages, onto the market, and they came out and they said, this time is different. And the whole point of the book was to show that this time is not different. And they use 800 years of data on financial crises around the world to compare what happens and all these things. And so his timing couldn't have been better. And his fame has shot through the roof. He's also, another interesting fact that a lot of people don't know is that he is a chess grandmaster. And apparently he had an exhibition match with the current grandmaster. This guy is in his 50s, or no, he's in his 60s right now. And he had an exhibition match with a current grandmaster recently, and drew. It's amazing. He's a full-time economist, but yet he still is able to keep up with chess. So he suggests a comparison with our current situation with that of Dorothy in The Wizard of Oz. And I assume everyone here has watched the original version of The Wizard of Oz. I once mentioned this in class, and a foreign student hadn't seen it, so they went home and they watched, but they didn't watch the original version. They watched an animated version, which is completely different. So if you haven't watched it, you should. It's an American classic. So what happens in it? The tornado sweeps across Kansas, and Dorothy gets swept up in it. Her home gets swept up in it, and she's spinning around and trying to figure out what's happening. And no one knows where she's going to land. I actually think Ken's metaphor is pretty apt in the current situation, due to the social, political, health, and economic uncertainties that this whole thing is thrust upon us. So for the next slide, I use Sir John Templeton of Templeton Funds. The four most expensive words in the English language are "this time it's different." And I didn't think that I would ever say this, but this time is different, really. The extent, speed, and pervasiveness is really unique. It's unique, remarkable. And I say that I'm guessing only that hermits are unaffected at this point. This is the first global recession since the Great Depression. The global financial crisis was a crisis and a recession pretty much among rich countries. This time it's pulling in developing countries and poorer countries into the vortex. And that's where this one is going to have a much bigger impact going forward. The speed of it has just been remarkable. The job losses occurred in 1/10 the time that they occurred in the Great Depression, and 40% of and it's not equally distributed. These things never are, but this is a fairly stark statistic. 40% of households making $40,000 a year or less lost their jobs just in March. And so part of this is the fact that the design of the fiscal and monetary responses are such that people can actually make more at home, but it's still a very remarkable number that that unemployment has shot up so fast. Even the influenza of 1918 was different. In that crisis, GDP grew at 9%. Of course, that was a wartime economy, so we would expect it to be different. But I was looking at it, and in case I've spent some time making comparisons and looking at the comparisons that have been made. Global deaths in 1918 were about 50 million people. And I've seen estimates all the way up to 100 million people. And I just quickly, off of Google a couple of days ago when I was putting this together, I looked at deaths divided by actual cases. And in 1918, that ratio was 0.1. And versus today, 2020, that ratio is 0.07. So those numbers aren't exactly the same. And my numbers, the numbers in both cases are subject to wide margins of error. But it was stunning to me to see just how close these numbers actually are. And then finally, I guess the question that's on everyone's mind is, when will the economy recover? And recently, just a couple of weeks ago, Federal Reserve Chair Jerome Powell said, for the economy to fully recover, people will have to be fully confident. And besides, I think that's a perfect way to express it. He's completely evading saying, well, it's going to recover in 6 months or recovering. He's not putting a timeline on it, but he is putting the preconditions. What will make the economy recover? And he said, people will have to be fully confident. And I think that's absolutely right. I travel a lot normally, and especially during the summer. There's no way I'm going to get on a plane and ride across the Pacific Ocean at this point. I'm not even going to get on a plane and go to New York. So that airline industry is going to be hurting. Many industries are going to be hurting because people are not confident that they're not going to get infected. And following that, just a few days ago, Narayan Kocherlakota, who's a former president of the Federal Reserve Bank of Minneapolis, says, of course, this would happen if we had a comprehensive national testing, tracing, and quarantining program. So I'll just lay those out there, two quotes from the Federal Reserve on when will the economy recover. So other new and worrying aspects of this pandemic are, the first one is really, it is new. Big three, so Bloomberg says the big three rating agencies are downgrading with a hammer, and that's unusual. Ratings agencies are usually very cautious. They usually try to project. They do it in half steps and quarter steps and not actually doing it, because many funds, many assets under management have a have a statutory requirement of their risk level. And so when the ratings agency downgrades unexpectedly, this forces a lot of these funds to go into the market and selling into a panic, pushing prices down further. So it's a kind of a crisis mode. And so that's an unusual thing that's been going on now. Perhaps it's a response to last time. The ratings agencies were under a lot of criticism for not announcing what's going on. This time they probably want to get out ahead of it. Obviously, global supply chains are disrupted. We've heard a lot of that. They were being disrupted before this, but world trade is going to decline. The World Trade Organization forecasts trade will decline between 13 and 32%. As the graph, the bar chart to the left indicates, expectations for recovery are being pushed back. The original hope was that we could just push the pause button on the economy, and so then when you push the play button again, we could have a V-shaped recovery. And now that's changing. Not many people expect that. This chart, by the way, is a summary of a survey conducted by Nate Silver at 538. His forecasting agency became famous for at least the last three presidential elections for having the most accurate forecasts of the vote count. And so his consulting fees have gone way up. But the movement, the weight of that distribution has moved further to the right over time. It was, so now now 30%, 50% don't expect the recovery to be until the second half of 2022 or later. And I think I would push it out even further. I would be in the later category myself. And then the flip side of trade flows is global capital flows. Capital flows in March, the reversal in March. Economists call this sudden stops. The reversal equaled the entire decline during 2008 and 2009. And this is why the developing countries are going to be really, really affected. There have been 26 downgrades this year, and many countries are either in default formally or technically in default. And I expect this to get worse. But for those of you who have taken my class, and Ishan, this is for you then. I do talk about in my class, there are opportunities opportunities across the business cycle, both in booms and in busts. And so the thought is that you should prepare for your future. So across the various business functions, so companies are going to be scrambling to reestablish these broken supply chains. My guess is that this is not going to be easy. And so there's going to be a lot of work reestablishing those supply chains. I don't think we're going to all onboard it into the United States, because you'll have problems within the United States as well. I mean, you could have problems, similar situations, no matter where your supply chains are located. Strategic decisions, now is a good time. Companies are clearly rethinking what lines of business they want to be in, what they're rethinking, reshuffling teams, flexibility has come up, they're rethinking about product mix. And what this means is that there will be growth. It will be sort of selective growth, even if it's not everywhere, but there will be growth. And I just point out that luxury brands, as well as very, very basic brands, tend to do well in recessions. And as Craig Lewis reported in an earlier professor's take, anybody working in corporate bankruptcy, private equity, mergers and acquisitions, there's going to be a lot of work, because we're seeing more and more bankruptcies roll out, and that's what will lengthen the recovery time, because of the capital that's tied up in these enterprises, both physical and human, it takes a long time for that capital to get reabsorbed in the economy, and that's what really draws it out. And then finance more generally, debt management, mergers and acquisition, think of fire sales and asset management. And so my advice is you probably are going to have to be, and I see that Sue is here. Sue could, I didn't run this by her before putting it together, but I'm thinking that sort of the shape of the job market is going to shift a little bit. And you really, this is a situation where you're really going to be needing to think about the value proposition and be cognizant of the business cycle. So I feel this is obligatory or mandatory because I'm a macroeconomist. What have the official policy responses been? Well, they've been pretty remarkable. The fiscal stimulus was, the CARES Act was over $2 trillion, and that even trumps the response, the fiscal response in the 2008 and 9 recession. And then the Congress, the House, has already passed a $3 trillion HEROES Act, which some of that will be passed. I mean, it's clear that not all of it will be, but some of it, most of the Republicans are fully on board for some of it to pass. The monetary response has also been truly remarkable. It's head spinning, just difficult to keep up with. They started by lowering interest rates to zero. They've added over $2 trillion to the Fed's balance sheet to support and open and reopen a host of facilities to support the economy. And for the first time ever, one of these facilities buys these so-called fallen angels, bonds that have fallen from investment grade to junk status. And the Fed has in the past never done that. So the goal of both of these policies, which I'll say was unprecedented, was to allow people not to work. So we wanted people to be able to stay at home and still continue to pay their rent, pay their utilities. Now, obviously, these programs have not been 100% error-free, but when you think about it, getting both houses of Congress on the same page and passing bills and then pushing those out to try to implement them, all in all, it was a Herculean task, if not 100% successful. The other thing I want to point out is, or want to draw attention to, because I'm kind of a China buff, is China's response. And a lot of the people are too young to go back 50 years, but if you could go back 50 years and think about how China could have responded, I can tell you they couldn't do it. China was an extremely poor country, and what they did in, whenever it was January, they shut down Hubei province and were able to feed 60 million people food and water and concentrate medical attention. We all saw the stories of China building hospitals inside of a week. And these are policy options that we have if we are rich. And this is why going forward, the poor countries are going to have a tough time. Their recovery is going to be much longer. The immediate outcomes will be much worse. I looked the other day at, just as a point of reference, I just mentioned that United States fiscal policy response was already over $2 trillion. I looked at Nigeria. Nigeria is their population is roughly half ours, and their fiscal stimulus is in the millions, not the billions, but in the millions, not the trillions, but in the millions. So they just don't have the resources, and that's why it's going to be a lot worse in those economies. This is going to be the next big shoe to drop. Europe is already trying to address this intra-Europe. there was news yesterday about reaching some agreement to the rich countries lending to the poor countries, the poor European countries. So this meme, it sort of strikes a chord. In the meme, there's a police investigation of a death, and that investigation is adjacent to a children's playground, and the two sides of the photo have been labeled the coronavirus crisis and the stock market. And I think a lot of people feel like the stock market is just unhinged from reality. I mean, this just confirms their normal bias that stock market just goes off and does crazy things. It's completely detached from reality. That may be, but I think there may be other ways to think about it as well. So the lower part of the picture is the stock market, and you see that it's up 32% from March 23rd. And this was as of a couple of days ago. I think it's up even more. It's continued this run. But remember, if you think about what the stock market does, the stock market tries to value the future earnings of companies. And if at the end of 2019, indeed, as late as January, we were in the longest expansion in US history, going all the way back to 1776. We have never had a decade where unemployment did not increase. That's where we were. Now, the most recent expansion, this long expansion, perhaps wasn't as robust as some other ones, but it was definitely long. And it's very, it's very difficult to remember that in February, as recently as February, unemployment was 3.5%. So if you're an investor in the stock, what are you thinking? You're thinking, well, these good times are likely to stop. Interest rates are likely to go up. And so, but what's happened since then? So in late last year, we were kind of at the end of this cycle. And what's changed is this comprehensive fiscal and monetary responses. These responses by the federal government saying that we're going to support the economy, we're going to support people, by the Federal Reserve, lowering interest rates to zero. No one now expects interest rates to rise. If you look at the slope of the yield curve, it's flat going out 20 years, indicating the market does not expect inflation. So, I mean, it's natural then in those situations with all the promise of the fiscal and monetary authorities for the market to expect that it will be supported. And so indeed, I think that the market probably would go up more if we didn't have the trade and political tensions. So I'm done with the economy, and I have a slide about teaching. So my classroom, and I didn't pull this off. This is not Owen, for those of you who have not seen an Owen classroom. But I pulled it off the web because it's a nice photo, the top one. My class has obviously changed from being in front of a bunch of people to being in front of a bunch of images on a flat screen with a chat function, in which I'm not monitoring the chat function, by the way. So if it's going on, I'm oblivious to it. It's also the rapidity with which changes in that has happened are pretty remarkable. It's interesting. I've been teaching intensively since Mod 4. I wasn't teaching intensively in Mod 4. It was a very fluid situation. It's for some people who may not remember, but the university was actually negotiating with Zoom in week 1 of Mod 4. So there was a lot of uncertainty, a lot of chaos. And since that time, there's been a lot of new tools and methods being developed. But I had great TAs, and I was really thankful for that. And the students were fantastic. They put up with a lot of my mistakes. I learned a lot, and I certainly hope that they did as well. And then right after that, I enrolled in a class at Vanderbilt, transitioning to an online teaching environment, and that's sort of getting the cart in front of the horse. And I'm now prepping summer presentations. And so I will say that I do love my commute, but I definitely miss the society aspects of it. So what's my profession's response been? The professional response is nothing short of spectacular. Normally, for those of you who don't know, the departments around the country and around the world have ongoing seminar series, and in these series they invite people to come and present their latest research, and it's a way to network, really. It's often a way to network with leaders in the field, so they're quite good things. But this one is from Princeton, the Benheim Center for Finance, and just looking at what's going to happen in the next the next week. Starting tomorrow, Gita Gopinath, she's the current chief economist of the IMF, and she's a professor of international studies and economics at Harvard University. She's going to be there. And the point is that many of these places normally they would be just for the people at Princeton. Now, most places are recording them live, and they're broadcasting them through Zoom. So you can sign up and you can participate in the seminar series without actually flying to Princeton or any place around the world. So it's a really interesting situation, and it's great. I have to admit, I haven't been to all of them, or in fact very many of them, but the opportunity is there. And as I said, they are recorded. So I have gone back and watched some of them. Bill Dudley is on Monday. He was the former president of the Federal Reserve Bank of New York. Darryl Duffy is next Friday, and he's a Nobel recipient. And my friend, Philip Lane, who's the current chief economist at the European Central Bank, will be also speaking on Monday, June the 8th. So it's a real opportunity, real sort of leveling of the playing field in terms of seeing what people are doing and participating, feeling like you're participating in a broader intellectual community, academic community. So the American Economic Association, that's the AEA here in this slide, they have posted a series of online seminars, and this is just a partial listing. And as you see there, it's a wide variety of online seminars that you can sign up for, you can present in, you can participate in. And this is just a partial listing. The American Finance Association has online conferences. So now normally in the summertime, we work all year trying to polish our papers and get them ready for summer presentations. But now we're not doing that, or we're doing that via virtual conferences. And so now there are a lot of virtual conferences, and in many cases, conference organizers are waiving the fees to participate in these conferences. So it's a pretty amazing situation. Again, this is a partial listing of finance conferences. This one is a really cool thing. The Center for Economic and Policy Research is a European center. It's the sort of European equivalent of the National Bureau of Economic Research in the United States. And they have a very vast and extensive website where they post a lot of the current research. So if you're thinking about doing a research project, that's one of the first places you go, is see what other people are doing on the same subject that you're working on. And so I was looking around the site, and I noticed that they had established they launched a new online publication at the end of March on the economic impacts of COVID-19. And so it already has 20 volumes. There is an overwhelming amount of research going into this pandemic and the economic impacts. So I just pulled a few of the papers, not the papers, but just the subject matters, and posted them there. It's kind of interesting. They've got a wide range of topics, religiosity. So the authors of that paper look at Google searches in a pandemic, and they find that Google searches of religious topics are up by 50%. So people are turning to Google to figure out, oh, how do we cope with this pandemic? Mental health issues, better measures of the economy is a big issue, because we're hearing about the pandemic in an almost daily update situation, but most of the data about the economy is quarterly or monthly, or some of it possibly weekly. And many places have moved to more of a big data approach to learning about the economy. And this is getting a real boost and acceleration during this period. So there's a lot of studies about how to better measure it using big data. And there's these other things about forecasting, gender discrimination. Interesting thing about gender discrimination, we know that the COVID seems to impact men differentially than women in a health sense, but in an economic sense, it's reverse. So men tend to die more from COVID-19, but women suffer in the workplace. Possibly because when they go home and work, all the duties for taking care of the children fall back to the women. And the other thing here is it just was mind-boggling. The first book came out, it came out less than 2 months after Vanderbilt shut down, and in fact the author only took 1 month to write it. And I'll refer it. I read it. It took me 2 days to read it. It's a fantastic book. So I highly recommend it. So I realized, I realized that I totally whiffed on one of the things that I wanted to get to. And that was why let me scroll backwards. Sorry. I would never do this in a real classroom. Where did it go? Oh, I know. It's this, it's the Zoom thing has interfered with my windows. I'm sorry for this. So it was when I was talking about the broader implications of the pandemic. And why is this not turning? Yes. So most people know about the broad implications of the pandemic and its effects, but probably a lot of you don't know that, in fact, the pandemic was inevitable. And it really resonated to me. I mean, we knew this was going to come, and yet now we're in it and we feel this sort of helplessness. But the way to think about it is to think, what really resonated for me was, the way to think about it is that there are about 1 billion viruses out there, and viruses have over time been considered life forms, and now they're not really life forms because they require life to live on. But it's easy to see why there's some confusion, because they're in this kind of never land, nebulous situation. Viruses mutate, and life forms mutate. So if they're not a life form, why are they mutating? And so with every mutation, there's a tiny probability that it can mutate into something really bad, like COVID-19 or Ebola or something like that. So what works for me is thinking about, suppose you had a 1 million sided die. A die, that's why I have the dice on this slide. If you had a 1 million sided die and you throw that, you cast that die, there'd be a tiny probability that something bad would happen, 1 in a million probability. But if there's a billion viruses out there, then you're casting that die a billion times. And the probability of one of those casts coming up really bad is 99.999999. You get the idea. It's not one, but it's almost a sure bet. In other words, it's inevitable. And so we knew that this was going to happen, and we just chose not to prepare for it. So I wanted to get that off my chest, but maybe it was not worth the effort. But at least for me, it helped understand, it helped explain the economics of the virus. So the final good news is, or there is some good news, and that's that drug traffickers are losing money. Apparently, their networks are more exposed in this shutdown, although I guess that's going to be reversed. And of course, pollution. This is a nice photo. I've seen photos from China where pollution's much worse, but here's one from Los Angeles, and it's just stunning to me, the difference between now and even last year. So there's my new TA. My class is over, but I have a new TA, and this is Casey. And I think for the most part, she's not really very helpful. She just likes to get in my way when I'm working. But I have some recommendations in case people are interested. The Financial Times has made their coverage of the coronavirus free. And The World After Coronavirus by Yuval Noah Harari, who I mentioned in my class for those people who've had it. He is an Israeli historian, and he's very thoughtful. And this is a really interesting read. It's only like a page or two. And I mentioned before The Economics in the Age of the COVID-19 by Joshua Gans. That book is also currently online. It's an MIT Press book. If you just scroll down the page, you can read it for free. And Joshua is going to be updating that book through the end of the summer, and then he'll stop updating it. And another book that I'm reading is Misbehaving: The Making of Behavioral Economics by another Nobel Prize winner, Dick Thaler. So that's all I have. If anyone has questions, I'm more than happy to have a further conversation if I can figure out where all the screens have gone.
Professor, there is, we do have one question. If you're able to open the chat function, we have a question from Harris.
Okay.
And if you're not able to find it, let me know and I can read out the question.
Let's see. Sorry. Yes, I can. So the chat from Harris. I have a question about rate markets. Yesterday, Fed's John Williams said that the economy might be bottoming and he expects pretty significant recovery in the second half this year. Why would he then say the Fed is looking at targeting the yield curve in the same statement? Shouldn't a pretty significant recovery guide the yield curve up gradually by itself, actuality is a significant recovery. So maybe I can ask Harris if you can explain what exactly John Williams was referring to. What are they going to be doing to the yield curve? The yield curve is already pretty flat. Is he talking about flattening it further or eliminating? I'm sorry, I couldn't hear you.
Can you hear me now?
Just barely. Let me see. Okay, try it.
Hear me now?
Yes.
Okay, so he was referring that the Fed is probably looking to control the yield curve in the future to keep the borrowing costs low.
Yes.
So what my question was that if the economy is recovering, shouldn't the borrowing costs go naturally up if in actuality the economy is recovering because the interest rates would go up gradually, given the demand supply mechanisms.
I think you're right, but I think it's just an issue of timing. I didn't hear the statement, but I think he was probably saying they're going to continue their yield curve operations at the moment. Yes, he's hoping that the end of the shutdown will cause the economy to restart, and so maybe that's going to be significant. But at the same time, we still have seen a lot of bankruptcies, and we want to make sure that the economy continues to recover. So I think they'll be continuing to hold the line and prevent further bankruptcies. I mean, certain industries like the airline industry is a great example. I don't see the airline industry bouncing back in the second half. And most of those companies are heavily indebted to begin with. So the short run's not looking good for them.
Certain businesses are not coming back to business and there would be some bankruptcies down the line. So given the demand supply mechanisms, the interest rates wouldn't go up, right? Because
that's right. Yeah. Yeah. I don't think they're going up.
So why would the Fed be worried about interest rates going up and target the yield curve, and at the same time think that there would be a significant recovery if businesses are going to go under down the line?
Well, I can just guess that if he's thinking that people will start going into the market trying to borrow, that would tend to push rates up. And so the Fed will try to make sure that doesn't happen. But I may be missing the whole point because I didn't hear it. I mean, I didn't see the statement by John Williams.
Thank you.
Yeah, I mean, one of the significant aspects of Fed policy recently has been flattening the yield curve, and I expect that to continue. And this should even the federal government, I believe, has introduced a 20-year bond, and they want to be able to extend the borrowing onto longer maturities so they don't have to refinance it so quickly, possibly after rates have risen. In fact, George Soros and other people have even advocated for governments to use consols, bonds that have no maturity.
Professor, we also have a question from Christopher, which is, how does our market response compare to market responses in Europe?
Thanks, Chris. I think ours was very rapid, and obviously Europe was dealing with Brexit, and They've taken a number of different approaches, as we have in the United States, because we instead of having a national approach to the pandemic, we have a state by state approach to the pandemic. But in terms of fiscal and monetary policy, coming out with this is one strength of the fiscal union in the United States. Europe doesn't really have that. And they only yesterday, I believe, and I didn't really follow it through, only yesterday were able to agree to a loan packages, because Europe is facing a very serious situation with Italy. If we add Greece and Spain and a couple of and Ireland together, they're only about 1/3 the size of Italy. And Italy is is very precarious at the moment, whether they will default or not. And Italy was one of the original strong supporters of the European Union, and now they're more or less talking like Britain and Brexit. So there are a lot of forces pulling the European Union apart right now, and part of that is because they don't have a fiscal federalism structure like the United States does. When Congress can get together and in one particular place, and federal government can issue debt to support areas in the geographic region of the United States that need it most. Europe, they still have a lot of independent veto power. It requires a unanimous vote, and many of the countries don't want to do that. So I think the United States is in much better shape, actually.
I think that might be it for the questions, Professor.
Okay, well that's good. I'm glad. I hope it was interesting to some people. It was good that I did this, because yesterday I was thinking about this, and yesterday I got a call from Scripps, and they were asking about the recovery as well, so I could just roll into that conversation, that interview, what I'd been working on for this.
Perfect. Yeah, I think it was some great insight that you provided. Thank you so much for spending this time with us.
Okay.
Thank you, everyone, for joining. As of now, this is our last Professor's Take session, but we will hopefully be getting a few more professors throughout the summer. So we will keep you updated through email notifications, and for the incoming classes, we will be posting on the Slack channels, so stay tuned. Thank you again for your time, Professor, and everyone have a great day.
Yes, thank you. Thank you again. Thanks, everyone.